Hi, everyone. Welcome to the latest Take 5. Sonu, we're going to call this one, Will the Bull Come Back When September Ends? Good riddance. September. So. Yeah, September hadn't been very good, has it? I'm good riddance to September, for at least from an investments point of view, right?
From you and me both. Good riddance to August and September.
True. Yeah, both of those. We've talked before. We had this great rally, right? Sonu, as you know, it was the best first 6 months for a year ever for the NASDAQ, the best first 7 months for the S&P since 1997. I think I was in high school back then. Long time. Now we've hit some seasonal weakness. August, September, not overly concerning, but I guess that's the big question. So, we're pretty optimistic that, yes, we had the rough times, but we're going to have a good, solid fourth quarter for investors. In a minute or two, what do you think will spark it? What will be the reason stocks are going to come back? The bull is going to come back now that September is over.
I think I think investors will get will come to terms with the idea that, look, that the economy is strong. There are a lot of headwinds now that everyone's talking about. They're talking about shutdowns, strikes. I mean, we talked about in the last video, student loan repayments, the Fed increase, the Fed being quote unquote hawkish. We'll talk about that, and raising interest rates. So all of that, right? I think all of those headwinds will probably go away, I think, over the next month.
So let's talk about the Fed for a minute. The Fed was just in the news. The Fed just said some things. I mean, what do you think specifically the Fed said, or maybe the Fed's going to do that could bring back the bull?
So the Fed paused interest rates, right? They didn't raise rates again. Now, they did keep their expectations for rates in 2023 at 5.6%. And that implies they expect one more rate hike, right, before the end of the year. I think that's only to keep some optionality in case they get surprised by inflation once again. The Fed chair, Jerome Powell, is extremely cautious about the path forward, right? He said, look, we've already done a lot. We've done it really fast. So now we are aware that there's a risk of over-tightening. So all that sounds like someone who doesn't want to raise rates further. So that's a good sign. So we think the Fed is done. Right. The other thing, the big shift is, look, they're buying the fact that the economy is strong. They increased their real GDP growth projection for 2023 from 1% to 2.1%. That's a huge shift and an acknowledgement that the economy is doing much better than they expected, right? You and I have been in that camp for a long time. The other side of that is a stronger economy raises the bar for rate cuts, right? So they're not going to cut rates as many times as they expected in 2024. I think the market's taken that like, oh no, the Fed's not going to cut rates as much as we expected. But I think they'll come to terms with the fact that, that's not a bad thing. It's because the economy is stronger than they expected.
And I think it's a great point. I mean, good news should be good news. The Fed is saying we don't need to hike rates as much anymore. We're probably about done. Inflation is coming back down to earth. But hey, the economy is actually strengthening. Although we've been talking about it strengthening for a while, the Fed is acknowledging it. I mean, the Fed can't come out and say it, Sonu, but did they pretty much come out and say there's no recession on the horizon? I mean, did they hint at that or not even hint at it? Did they make it a very broad-based, obvious discussion that there's no recession coming, you think?
I think so. In short, they said, look, we think core inflation will actually be lower than we expected back in June. I think core inflation, so this is inflation excluding food and energy, right? Yep. That's what food and energy tends to be volatile, so they focus on core inflation. They think that's going to be 3.7% by the end of 2023. That's lower than the close to 4% that they first expected, right? Now, the bigger deal was they lowered their unemployment rate projection. Initially, they thought it would be 4.1% in 2023. That would go to 4.5% 2024. Look, that's recessionary, right? If the unemployment rate goes from 3.5 to 4.5, 2 million people lose their jobs. Usually it gets worse, right? Animal spirits and all of that. So that's recessionary. They never said it, but that's it. But now they only expect the unemployment rate to go up to 4.1% by the end of 2024. That's not a lot. But it's a big shift from where they were before this. And it basically tells you, look, initially they were in the camp that to lower inflation, we need to put the economy into a recession. They didn't explicitly say that, but that's what they were projecting. We need the unemployment rate to go up, right? Right now, they've come to terms with the fact that, the economy is strong, but inflation's falling, and we think that can continue. So that's a good thing.
Great thing. So let's wrap this up here. We're entering the fourth quarter. Historically, for investors, Sonu, the fourth quarter is one of the best times for the stock market, up about 4% on average when you look at the S&P 500 in that fourth quarter. But here's where it gets interesting. When you're down at least 1% in August and September, like we're going to likely be this year, the fourth quarter is even better, like wildly better. You had some really big gains in October historically, but you're up like 7% on average in the fourth quarter when you have that seasonal weakness ahead of time, up 12 out of 13 times for the S&P going back to World War II. So just some things to think about there, and just sentiment. We've talked before about some overall sentiment. I mean, you laid out the economy on pretty good footing. We've had the pullback over the seasonal weakness time frame. People are starting to get worried again. I don't want to get too geeky with the stuff we look at, but I'll just put it like this. Fear is coming back. Fear is a good thing to refresh markets, to refresh, the Johnny-come-lately bulls that came in at the late summertime. And we think, again, these are all reasons that the bull market is not done. And September might be over, but that's going to be a potential positive thing for the fourth quarter for investors. So with all that, this is the latest Facts versus Feelings Take 5. We'll see everybody next time. Take care.